Major support for these broadcasts is provided by the CUNY TV Foundation, New York Community Bank, Chase Commercial Term Lending, Chelsea Lighting, Capital One Bank, Genova Burns, Giantomasi and Webster, Kilroy Architectural Windows, New York's Window Company, the Witkoff Group, Greenberg Traurig, M&T Bank, Perfect Building Maintenance. Additional support is provided by Ackman Ziff Real Estate Group, Bank of America Merrill Lynch, Briarwood Organization, C.B. Richard Ellis, Colliers International New York, Cushman & Wakefield, Dime Savings Bank of Williamsburgh, Douglaston Development, Levine Builders, DDG, Friedman LLP, Accountants and Advisors, Flushing Bank, Herrick Feinstein LLP, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, James Orphanides, Centurion Holdings, John Katsimatidis, Red Apple Group, Corman Communities, a.k.a. Hotels, Madison Realty Capital, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey Knackle Realty Services, New Banks, Meridian Capital Group, Newmark Grubb Knight Frank, Popular Community Bank, Sterling & Sterling, SJP Properties, Stonehenge Partners, and These Friends.
"2013. What will the year look like? How is my crystal apple going to be? Is there going to be money for real estate and other products? What's going to happen with the tax law?" I'm not that smart, but I got people who are, and they're going to talk about their thoughts on where the financing is going to come in, especially for commercial real estate. My guests today include Ben Stacks, who is the Market Manager, Senior Vice President for Commercial Real Estate for Capital One Bank. John Adams, who's the first Senior Vice President, Commercial Mortgage Origination and Administrative Officer for the New York Community Bank family of banks. John Costa, who is the Executive Vice President for Commercial Real Estate for People's United Bank. And last but not least, from Williamsburg. He really lives up in Westchester, but his business is in Williamsburg. My friend Dan Harris, who's the Executive Vice President and Chief Lending Officer at the Dime Savings Bank of Williamsburg. So you are that nice little community bank in Williamsburg. You know, you have the Dime over there. How do you see 2013? 2012 was better than I expected. So how do you see 2013, Dan?
2012 was a great refinance boom for everyone in our sector. I think 2013, as rates stay low, is going to continue to be a very busy year with refinances. Sales are starting to pick up. You know, the tax law may actually increase some of that. It certainly is increasing it for all of us at year end as all the sellers are trying to get their deals closed.
So okay, I think that's an important point. But that's the end. We're taping a show on 12-12-12, which someone said, you know, it's an interesting thing, 12-12-12, and it's also Frank Sinatra's birthday. He would have been 97 years of age today. But what happens on January 1st? Taxes go up. There's a Medicare tax of 3.8%. There's potentially other taxes, higher taxes. Do you see people selling properties? I
think real estate will remain one of the favored sectors for tax benefits, and I think people are going to continue to flock to real estate to protect their income from taxes. So I think it continues there versus a lot of other industries. I mean, it's a great place to be.
And I think that's especially true in New York, which, you know, over the last 20 years has really become a very, you know, transparent, highly desirable investment market. And so you have, you know, not just the New York folks that are looking to invest here, but also international capital. And I think that, you know, more so than other places in the country.
You know what, that's an interesting subject. Of the business that you did in 2012, and I was sitting over here and I heard this little community bank did close to $9 billion, Mr. Adams, how much would you say of that business that you did was with, let's say, foreigners or people who have joint venture equity or private equity from foreign sources?
I'm going to say this past year we saw more of that than we have in the past. Probably of that number, 15–20% of it easily was investors, large REITs, and/or foreign money. There's Canadian pension funds. Everyone's looking for a safe investment with a good sponsor, and they're very happy today with a 3–4% return, and that's really all you're going to get in today's market on a market rent property is that type of return, and it's better than money sitting in the bank earning 15–20 bips when you can get a 3.5–4% return.
You're not giving 2% money market at New York Community Bank?
No, you might get 15 bips in a toaster, but you're not getting a 2%.
Wait, we can get toasters?
Absolutely, for you, Michael. And
Okay. Now, John, you joined People's, and People's is a great bank, I mean, with a long history going back 1850 or something like that, from as a small bank. How does People's, who's a Bridgeport and a main bank, how do they look at the New York market? And let's not be so New York City centric. How do we look at everything? And that's what I would like, in their market. How do you see the market?
You're right. People's has been around for a long time. I think it's 170 years at this point, and it's probably the largest bank, depending on who you count, headquartered in New England at this point, outside of foreign ownership. But it's also has a very substantial market share in its home market, which is Fairfield, New Haven, Hartford area. In order to grow, it needs to grow in either or both Boston and New York City, and it's really decided that as it grows, it has this great credit culture, it has a lot of capital, it needs to deploy it where it's going to get the safest and best returns, and that happens to be the New York area.
A couple of weeks ago, I went up to Stamford. I hadn't been there in a long time. I see there's a lot of new construction in Stamford, a lot of new apartment houses. There was a brand new Fairway. They opened up a new Chelsea Piers, and NBC Universal is having their sports over there. How do you see the Connecticut market? I mean,
Connecticut market still continues to develop. Look at relative size, though. If you're looking at the Connecticut multifamily market, is it 100,000 units, 200? I don't know the exact number. Compare that to the New York metro market, which is 1.5 million units. So there's a scale there that's just totally different. You can be a very big player in Connecticut and still not capture the market you need to capture to grow.
Ben?
The world?
I mean, in the
yeah,
financing.
Sure. Look, I think that, we've talked about it many times before, we're a very sponsorship-driven institution. And so to that end, and, in and around New York, we'll follow our top sponsors wherever they go. If they go to Stamford, by the way, I shop there at Fairway. I love it. But it's, we'll follow the folks that we've really decided to bank.
But here's the question. Most of you, I'd say all of you, are active in the multifamily arena. But real estate is not a single asset class. Real estate is a variety of asset classes. So which assets do you see for 2013 that there's a better potential for you to finance and which will do better in 2013? Is it industrial? Is it, data centers that you and I have discussed? And it's very interesting because I'm not that overly zealous on data centers, but I saw a guy who's on the investment committee of M&T Bank who said he's building a lot of data centers. Is it lifestyle centers? Is it retail? Is it hospitality? I mean, how do you look at other areas? Because first of all, regulators say, it's nice to be in multifamily, but you better diversify a little bit too.
Well, but if you're looking at other areas, you have the urban versus suburban markets too, because a lot of products work in urban areas that we wouldn't want to be in suburban areas anymore. I mean, if you look at what we're doing, we're not just multifamily. We're actually seriously looking at Class B office in Manhattan right now as a sector that we think we should be more engaged in. And it goes back again to sponsorship. We find the right sponsors. You invest a lot of time up front to get to know them, but then you follow them around.
I'd like to echo that. Yeah. I mean, it's the same thing for us. So that under the umbrella of good sponsorship, we can do a lot of different things, and that's really our MO. It's not saying, I want to be in the multifamily sector, which, by the way, we are, but, it's a broad base.
Interesting. John, not 2012, but in 2011, did some major offices.
We did.
I mean, close to over $1 billion of offices with good buildings. Now, every one of them, I would say, was an A office building. on the large deals.
On the
large A, B plus, because
B
Starrett
plus,
Lehigh
right.
was more of a B
Right,
plus.
right.
But they were A properties as opposed to B properties.
But with those properties as well, there was upside. Looking at those rents, you could look at that rent roll, whether it be leases coming due or space available.
I mean, look, the
So marked
repositioning of
below.
1370 Avenue of the Americas was an unbelievable, because the building hadn't been touched in years, and it was really an interesting point of view. But I'm not certain. I think the New York City office market has B offices. Even if it's good sponsor, there may be danger. And what I'm saying is,
I agree.
we happen to have a lot of new construction coming on board. You know, Lower Manhattan is going to have this construction. We don't have these tax credits that we used to have before in Lower Manhattan, like the 421Gs, that you can convert an office building to an apartment house. So you're going to have a vacant office building, and you can get office space in a B building for $22 a foot.
Right. And you have a lot of these sponsors who are looking at this well-located B office buildings and are forecasting $60, $70 rents per square foot. And if you're underwriting at that level,
But you don't underwrite that way.
Right.
you're just going to get burnt.
We underwrite
you have
at
to
the
underwrite them at
$25 a foot range.
or 30, depending on what it is. But you can't underwrite what they're forecasting at, because they're never going to get it.
I mean,
based on
Midtown
the
South is one
competition.
of the one of the strongest markets in the.
Midtown South is the strongest market, and it was very interesting. A couple weeks ago, I had Eric Garau of Newmark Holdings, who owns lots of B and C properties, and they had property on like 14th Street and 8th Avenue. He said, we have union tenants over there who have shag carpet. And you know, we were getting $20 a foot, and we couldn't care. And now we get $40. 40, they could get 80. I mean, who was running to Midtown South? Who was going to a side street? But with regard to side street, that relates to the discussion that we had before about the hospitality industry. I mean, in Williamsburg, when did you ever believe that there would be a King and Grove hotel and a Wythe hotel in Williamsburg, and they're packed?
No, the hospitality industry over in Williamsburg, from non-existent 7 or 8 years ago, has a number of hotels now. Not huge, but a little boutique-ish, and they're doing well. Whether you want to finance that or another, you're going to finance it at a relatively low final value leverage. I mean, that's the key. And that's the key in the city too, with the retail and the office. We want multiple tenants. I don't want to have one tenant being 20 or 30% of the square footage or the cash flow, because then you really have to dig deep and be comfortable with that tenant, because everything else becomes noise. I'd rather have a bunch of 2,500 square foot tenants, and then we get very comfortable with it.
Ofer Yerdeni the prior week was talking about his tenancies in his residential buildings, and he said, I like restaurants, I like small boutiques, I like clothing stores, and I don't know, since I'm a lender also, I've always been cautious, because restaurants are very difficult to run in day-to-day operation, and I don't, clothing boutiques are fine, but they're difficult. I would be more happy in a way with a 7-Eleven, even though it may not have the charisma of the entrance, but
I think it depends on the neighborhood. It depends on the needs of the neighborhood and what kind of tenants need to fill that space. So, I mean, would you prefer credit tenants in all of your retail? Of course, but I think the city is so dynamic in so many different ways, and the neighborhoods are so dynamic that they demand different kinds of services. So for us, it's more of a location issue. Does the location support continued retail usage?
And once a space is built out as a restaurant, it has value just because it's been built out. And even if the first guy fails, someone else will come in as a restaurant user and save all that capital expense, and that's significant.
Sure. Yeah, we're not adverse to restaurants, but we don't want that to be the main source of rental income.
Here's I'm doing a show next week on healthcare, but a very interesting statistic came out. Retail health facilities have increased they were about 1,350 in the nation, and last year it went up to 2,850 units. Now, with Obamacare and other situations, people are they don't want to send them to emergency room, they rather send them into a doc in the box or whatever you want. Have you financed healthcare? I mean, doc in the box, or these emergency medical centers being privately owned or being owned by a hospital chain?
No, but I will tell you, as all of us with our health benefits in our own shops, is they are tweaking people's individual health plans to force you to go to the private doctor and stay away from the emergency room. I mean, you know, we've just gone through this routine, and it's significantly more expensive for an employee at our institution to go to an emergency room than go to a doctor or a rapid care center, you know, with the doc in the box.
So
they've got to
okay,
grow.
So they're growing. Do you think, I mean, that's probably an asset class that would not normally, you would be seeing that much.
But there's an alternate use to that space as well. So in the event that it did
Can we
not,
put a bocce court or a bowling alley?
and I don't know if to that extent, but I mean, the office to some extent, flex type space. So I don't think we would be adverse to looking at, you know, the dock in a box type space, provided again there was a strong name behind it, whether it be a hospital or someone with a good long reputation. But again, it's not specialty use where you'd be boxed out.
They're going to take 1,200 square feet in a retail strip.
Exactly. I mean, if it's a single tenant use someplace else, I would, you know, question it a little bit.
How do you look at, you know, the state of New Jersey and Long Island, Nassau, and Suffolk? Because I had done a show a couple weeks ago. I had Jim Coughlin Jr. on the show, and you know, he said, look, nothing's really happened in Long Island with regard to the office market and certain other things. And to be realistic, Stamford, with the exception of what happened recently, nothing happened in Stamford.
Well, they had a big scare with UBS. I mean, UBS almost left, and they had to give them massive tax breaks to keep them in. You know, I think, you know, Long Island and New Jersey are kind of similar in that they've been, you know, it's been a very slow recovery, especially in the office sector. Now, you know, there was actually an article recently about multifamily in Stamford that's really doing quite well. So I think it's a kind of a tale of two cities.
How do you look at the, you know, the multifamily? I think everybody likes multifamily. I believe, you know, the Jersey City, which many people consider the sixth borough, has always done well. How do you, you know, there's the proliferation of construction in downtown Brooklyn and also in Long Island City. How do you look at that today?
There's demand for it, and the economics are finally at a point where it pencils out for these developers to start doing this. And with all the capital coming in, if they don't want to hold it, they have an easy way to turn a profit on this stuff too.
You bring up a point about there's a demand, and part of the demand that we discussed briefly prior to the show was the question of how high rents could go before people consolidate, move into a place, or even perhaps buy. So that relates to the subject of construction for condominiums and so on. How do you see that market, and how do you see the banks reacting in that market?
I think condos are still an unknown, not to say an unknown, but it's still
Scarlet letter?
Yeah, I think a little bit, yeah. I mean, unless you're underwriting them as a rental project, because let's face it, if it's one building, you got to go from start to finish before you could close one unit. So the market could do many different things from the time you start to the time you finish. So you need to look at it as a rental property, at least in our shop, in order to even consider it. But still, financing condos is still not easy.
But
when you're a buyer.
But wouldn't we say that the condo world is a tale of two cities? The luxury condos, which you're involved with some of the construction over there are X number of units on 57th Street where Gary Barnett is building the Extel building. There are X number of units at 18 Gramercy Park and at the UN site at Eastgate and the Zeckendorfs. And there are X number of people who are that wealthy from Russia, from China, and other places that they'll absorb the...
That's an asset class amongst itself. You know, the normal Manhattanite who works downtown or in the Wall Street area who's not making, you know, multi-million dollars a year, that market, I think, is still not as strong as it could be if there were more lenders who were willing to make loans on these condominium units without having to worry about selling it off to the secondary market and getting in their documentation in line with Fannie and Freddie.
Now,
we're kind of our own enemy in some.
Part of the situation is, and we were talking before about Williamsburgh, where you've financed, I believe, maybe in the past. I know everyone else. Williamsburgh, you know, you had the Edge, you had the towers, you know, the Toll Brothers development, and then, you know, because of the world ending in 2008, and now it's like every corner, every site, there's something going on.
And they're big ones. It's not, you know, for over the last 3 years, I've seen a lot of, you know, fill in the space buildings, 8, 10, 12 units going up just on the side. Now you're seeing 100-unit projects, you know, on North 11th Street, right by McCarran Park. There's this, it's a city block. The thing is humongous. You know, those are big projects, and you know, presumably the lender's underwriting them as a rental. Presumably they'll act as rentals, and people are getting 42, 45 bucks a foot for a rental in those new buildings. You know, new still attracts. Williamsburgh is on fire. You know, people won't even, you know, the young group that's been pushed out of Manhattan now went to Williamsburg. Now they're being pushed to Bushwick. I mean, it's an amazing story.
I think you're right on. When people, they're moving to Bushwick, when are they going to move to East New York and Brownsville?
It's a matter of time.
Yeah, a matter of time.
What about Coney Island?
Coney Island, you know what? I was just in Coney Island. There's still
little rough right
that's
now.
a while. That's not an area that's going to come back anytime too soon.
Why do you believe it?
They're still
From the
recovering.
hurricane?
Sandy,
Oh,
yeah.
I just was there this past Saturday, and
Right in Coney.
I was amazed at how far behind they are in the cleanup process compared to, let's say, the South
But
Shore
you know
of Long
what?
Island.
You bring up a very important point. You know, 2012 we had the disaster of Sandy. How are you looking in 2013 when you underwrite a loan, either a new construction or an existing construction, with regard to what happened in Coney Island, with what happened in the Rockaways, what happened in these areas? Ben?
You know, it's honestly, it's been kind of no change so far. I mean, we're still, you know, assessing the longer term impacts of what happened. But I mean, I think initially we were very diligent as it was in underwriting the projects and the sponsors and making sure that, especially on the sponsor side, that they had enough wherewithal to withstand, you know, financial shocks and other things like that.
Are you going to change your insurance requirements when you underwrite a loan?
You know, we've all learned that flood insurance is great, but it's you know, $500,000 on a commercial building max
Doesn't get you
mean
much.
anything.
Right.
I mean, we have a hotel out in Long Beach, and the lobby got hammered. And it's $1.5 million. You know, owner's got to come up with $1 million bucks, and you know, there's no
He's not asking his banks to come up with it?
No, he may ask, but no, that's an owner's responsibility, of course. But no, he's doing the right thing, and you know, we'll throw in the $500,000 of flood insurance proceeds as they come in to help rebuild. But you know, we've all, you know, flood insurance is a very big deal mechanically and regulatory to make sure you have it. But I think until this, none of us really said, you know, it's just purely inadequate. You know, people doing $1 million Dune Road loans,
Right.
you know, with $250,000 of flood insurance without private supplemental insurance. I mean, I've always seen it, and I've always said, gee, you know, why does everyone do this? I think now we've, you know.
But
it's a
what
mistake.
about, you know, there are certain developments in Manhattan and other parts of the city which happen to be near high water zones, okay? Or
Zone A.
Zone A type of situations.
B.
You know, how are you going to look at that? You know, you have a fiduciary responsibility because you're all publicly held entities of how you're underwriting. How are you going to look at those situations? Everybody's talking fine. Everybody has a generator now. All of a sudden, Home Depot in the world and every store has generators. Generators are going to be on a higher floor, then they're going to be at a lower level and this and that, and they'll be encased and all the rest. But how are you going to look at other situations because of the effects of, because someone said
Actually,
there's another chance. that
I
this
think it's going to be more insurance replacement value driven rather than, like Dan was saying, the minimum $500,000 for a commercial property. Ideally, you would love it to have replacement cost value, at least for the first couple of floors, and properties never flooded in the past. It was pushed back, so there were times that you did agree to the minimum $500,000 because you're never going to have a flood. Well, that's not the case anymore. You have to really put that into perspective, and in addition to the $500,000 you're going to get through FEMA, you're going to also look for supplemental private coverage for that gap between whatever your replacement value is.
You also had an infrastructure failure here, and how do you figure out what the city's going to do to prevent, you know, the flood was one thing, and then take that to the next step. People couldn't move around. People couldn't get to the store. People couldn't get to work. And that wasn't a building-specific situation. That was an infrastructure failure. And how do you now start looking at, I've got a great building, but everything around me now has shut down. What do I do with it in that case? So I think it's a much larger issue.
I brought up that subject a couple of weeks ago, and I was talking about somebody saying, will these hurricanes or other natural disasters have an effect on people living on the 90th floor of a building? It was like after 9/11, people didn't want to be high up in a building. Do you think still buildings are being built at high levels? People command more higher rents?
I think it remains to be seen.
Yeah.
I think it's too close after the event for people to really, digest exactly what happened and what the behavior is going to be.
Let's get to the subject which I've been talking about quite a bit, and we discussed it earlier today, the hospitality market. You walk down my studios on 34th Street. If you walk from 34th to 39th Street, you will see about 30 hotels and about another 6 new hotels under different various stages developments. Hotel business is like a restaurant business. Each day the register opens, each day the register closes, you got to bring them in. And there is some new software on the internet where prices can go down and the customer pays a lower price. How do you look at, as a lender, how do you look at the hospitality market?
For us, we lend selectively, and it comes back to who the sponsor is again and how leveraged he runs his business. So it's very selective for us.
You know, Ben is in financing. He's one of the consortium of one of the we don't have 5-star hotels really. We need 5-star hotels the same way that we spoke about luxury condominiums. How do you see the 5-star hotel, the new?
I mean, that particular transaction, there was a substantial amount of support from the operator up front,
Yes.
which got us very comfortable. But we're cautiously optimistic about the hotel market in New York, including the 5-star market. And I think going back to what John said, again, it's a sponsorship issue, and it's the experience of the sponsor, the experience of the operator, and the location of the hotels. So
Here's a question: What if there's the least asset class that you wouldn't want to feel comfortable in financing? What is it? Is it vacant land? Is it entertainment centers? Is it
golf courses?
Golf courses? I mean,
I think it's the alternate use concept. If you have a use that can be easily transferred to, land, I don't know if it's as much of a concern as, let's say, a movie theater. You're lending on a 16-theater multiplex that's only a movie theater, that's constructed as a movie theater. That's a little bit of a different asset class.
But if you're constructing a movie theater within a complex and you can use an alternative use later on, maybe it's a different category.
Yeah, but that's an expensive build-out.
Retrofit. It's
Right.
a very expensive retrofit.
We're looking for certainty of cash flow. So if we can get comfortable that there's cash flow there and it will be there for the duration, we're probably going to be able to get comfortable, provided the sponsorship is right.
So
land would be out in that case.
quick question, because we only have a couple of seconds left. How much additional production do you see yourselves increasing from the high numbers which you did in 2012 for 2013?
We're just starting, so
Oh, you're the new kid on the
we're the new
block.
kids. So we'll probably close 300 or 400 million this year, and we're probably looking to triple or quintuple that production next year.
Dan,
I would like to do about the same. We did about $1.1 billion this year, and I think next year would be happy doing about the same. It'll be more challenging, however.
We did a little bit more than Dan, and we're probably going to be roughly flat again for 2013.
and you, 850-pound gorilla?
I think if my staff heard me say that we want to do more, they'll probably all walk out. I think we'll be very happy if we could continue the same momentum we have the past couple of
So
years.
I'd like to thank my group of distinguished bankers who provided their insight. I'd like to thank Ben Stacks, John Adams, John Costa, and Dan Harris, and I'll see everyone next week. Thank you.